Good afternoon, boomers. Brian Tong here from Boomerlife. Today I'm doing a blog on understanding mortgage interest rates to avoid mortgage fraud. What you need to know. There are key takeaways here. Common individual mortgage fraud scams are identity theft and income asset falsification, while industry professionals may use appraisal frauds and heir loans to dupe the system. Predatory lending activities, foreclosure rescue, and mortgage reduction scams all contributed to the Great Recession in 2007. Mortgage fraud continues to be a problem in America. According to CoreLogic data in September 2018, 1 in every 109 mortgage applications shows indication of fraud. There are professional organizations that monitor and investigate mortgage fraud, along with the FBI. So if you need to repair your credit, there's a link I put in the blog to stick in your browser. What is mortgage fraud? In the simplest form, it's deliberate misrepresentation and deception. One party deceives another by misrepresenting information, facts, and figures. So mortgage fraud is not just predatory lending practices that can target certain borrowers. Housing or mortgage fraud can be committed by individuals who intend to occupy a property as a primary residence or by groups of investors who defraud via rental properties or common appraisal fraud when flipping homes. According to the FBI, it is any sort of material misstatement, misrepresentation, or omission relating to the property or potential mortgage relied upon by an underwriter or lender to fund, purchase, or insure a loan. With this working definition, we can see that mortgage fraud can be committed by both individual borrowers and industry professionals. And the sums are high. For example, in Sacramento, California, 7 people were convicted in a $10 million mortgage scam in early 2019. Why commit mortgage fraud? Well, obviously, borrowers and professionals are motivated to commit mortgage fraud for many reasons, mostly money. We can describe most of these reasons by defining 2 primary types: fraud for housing and fraud for profit. Fraud for housing is committed by borrowers who, often with the assistance of loan officers or other personnel, misrepresent or omit relevant details about employment and income, debt and credit, or property value and the condition with the goal of obtaining or maintaining real estate ownership. Fraud for profit is committed by industry professionals who misstate, misrepresent, or omit relevant details about their personal or their client's employment and income, debt and credit, or property value and condition with the goal of maximizing profits on a loan transaction. It is important to note here that fraud for profit can be committed by any professional in the loan transaction chain, including the builder, real estate agent, loan officer, mortgage broker, credit debt counselor, real estate appraiser, property inspector, insurance agent, title company, attorney, and escrow agent. Industry professionals can also work in concert as a network to defraud underwriters, lenders, or borrowers and maximize fees and share profits on all mortgage related services. These actions are motivated either by the desire to gain extra sales commissions or simply increase an investment position. So, what are the scams? The most common are different types of property flipping, occupancy fraud, and the straw buyer scam. In the case of the same day close property flipping scheme, the chain of title and the appraisal are often fraudulent and included 3 parties: the seller, the flipper, and the unsuspecting end buyer. The seller makes a contract with the flipper to purchase the property at below market value. The flipper provides the end buyer with a fraudulent title insurance commitment showing the flipper as the owner, though that's not the case, and an appraisal is made at the inflated price the flipper and the end buyer have agreed on. Occupancy fraud is a scheme used by investors to qualify for higher loan to value ratios and lower out of pocket costs on purchases, in addition to lower mortgage rates. Occupancy fraud occurs when a borrower claims that the home will be owner occupied to obtain favorable bank status when the property will actually remain vacant. The straw buyer uses or allows someone else to use their identity, credit score, and income to obtain property for another buyer who may not qualify for a mortgage or qualify for the best rates. Straw buyers are often used by investors, either willingly or unknowingly, to cover up other forms and multiple layers of fraud. The most common individual mortgage fraud scams are identity theft and income asset falsification. Identity theft occurs when the real buyer fraudulently obtains financing using an unwilling and unaware victim's information, including social security numbers, birth dates, and addresses. Identity theft for mortgage purposes may also include stolen pay stubs, bank records, tax returns, W-2s, and falsified employment verification letters. Even property ownership records can be falsified, and borrowers can obtain a fraudulent mortgage on a property they neither own nor occupy. So, combating mortgage fraud. There is no shortage of legislation at the local, state, or federal level designed to reduce mortgage fraud. States have taken a big step recently by requiring loan officer licensing and continuing education. Additionally, real estate, title, and insurance agencies are licensed and monitored by government agencies. Many states also require periodic auditing of mortgage lending companies' activities and transactions to monitor compliance. Professional organizations such as the Mortgage Bankers Association and the National Association of Mortgage Bankers have a code of conduct and best practices that are peer monitored. The FBI Economic Crimes Unit also monitors complaints and suspicious activity in the mortgage industry. The bottom line is the good news that we can improve the markets by reducing mortgage fraud. Individuals must set realistic expectations for borrowing and homeownership experience. Investors should set a realistic goals for profit. Industry professionals must pursue higher personal standards and submit to peer organization accountability. Governments need to make the legislation more uniform and reconcile law enforcement with active investigations. That's one of the problems that I run into as a lawyer is oftentimes people will have something like this happen to them, and the police tell them, well, that's a civil matter. You need a lawyer and you need to file a lawsuit. Hopefully, more government crackdown will follow in the years to come. And that's it from Brian Tong at Boomerlife today. Boomers, have a great day. I'll see you on the flip. Over now.